Hello and welcome to Asking for a Trend. I am Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here's some of the trends we're going to be diving into. Call to comeback stocks attempted to claw back those losses this Monday, the first trading day following news of a credit downgrade by Moody's. The Dow ended the day in positive territory, closing up, along with the S&P 500 and the NASDAQ in positive territory too. And the real estate sector may be flying toward the future with specialized AI tools and robotics to help improve architecture, construction, and listings. We're taking a 360 look at what impact this is having on the housing industry. And from Wall Street to Sesame Street, Big Bird and all of his beloved friends are moving to the Netflix neighborhood. We're taking a look at a new deal inked with PBS and the streaming giant. While tariff uncertainty and elevated mortgage rates weigh on the housing market, we know artificial intelligence and robotics, they are transforming the real estate industry. VettaFi senior research analyst Zeno Mercer joins us now to discuss. Zeno, always great to see you.
Good to be back.
So let's start. Got a new report out. And basically, Zeno, you're walking people and your clients through this idea that AI and robotics, they're transforming the real estate industry. It's driving what you say is this real transformative evolution of the industry. Walk us through it, just high level. What do you mean by that?
Yeah, so AI and robotics are, traditionally, robotics has been traditionally, people think of it as manufacturing and logistics, but it's going to be a lot more than that. It's already starting to be. AI, we already know, can drive efficiencies and connect the dots and improve, efficiency gains in a lot of places, but high level, if you break down like real estate, the use of real estate, and the use of really anything in the world, you're making things, you're moving things, you're manipulating things, or you're storing things. That's majority of GDP fits into that bucket. With real estate, if you think about it, AI and robotics are going to transform the entire life cycle of real estate. So you've got the design. So how are you building things? Where are you building things? And so there's a couple considerations there. So you're going to have AI and robotics used in housing, in mobility and transportation. You're going to see things like parking lots turn into parks as you see less need because we have autonomous vehicles that don't need to park. So there's a design element where AI and robotics or artificial intelligence will redesign how we're thinking about designing. So companies like Autodesk, players like that will have a huge play into just like that system of designing. And there's also the materials and energy designs that are going to come into play. So if we think about, we run on energy. The most advanced economies have higher utilization of energy. And so that's a big component of that is the energy efficiency. So now we're moving on to once we've built, or we have to design it, then we build it. Right now, robots have pretty low penetration into actually building things. It's still very physically manual labor intensive. You do have some fab construction where like they pre-make it and there's some 3D printing things, but on job sites, it's still very manual. And there's a lot of room, there's a lot of need to improve the efficiency here. We have labor shortages and we have unmet needs. We have housing crisis. People can't afford to live here. Or operating system really isn't functioning. We have a lot of debt. Like we can't really operate the way we're going. So we actually need to use more AI and robotics to improve that side of things. Next stage is actually operations. So AI will become the operating system of buildings. And so that's energy efficiency, that's improving the quality of life. Think about the aging population. A lot of them get sent to nursing homes, but like in reality, it's like, why can't more people live at home? So if you start to add AI, you have more energy efficiency, you have more robots that can accomplish more goals. That actually fundamentally shifts where people will be thinking about development of real estate because that'll change people's lives. And so it also goes into like data centers and other things. That energy management component is very, very important.
When you think about the real estate industry, though, it can be a highly regulated industry and sector. Does that pose any kind of challenges or obstacles to deploying and integrating this kind of next-gen tech you're talking about?
It's a huge opportunity because right now, let's back up to like Doge. Okay, I think we've brought up Doge on the show before, but in this case, we're not trying to move fast and break things. We're trying to move fast and make things. And if we're doing that, AI can actually improve how we're validating and reduce the red tape speed, like the cycle. So, permits take too long. There's a lot of like opinions and local governments that are kind of getting in the way and stopping kind of NIMBY versus YIMBY. And so AI can also be used on the flip side of the governance side of saying, like, why do we have these regulations? Is this for safety, energy efficiency, and codify that? And so now these codes are, these laws can be codified and made easier. So we'll see faster uptick and reduce cost. And so developers will say, like, oh, I'm more likely to be able to get this through the door faster. Here are the incentives. This is what I need to do. And so you can actually see improvements from that. But yeah, I mean, people will talk about energy consumption, and there are a lot of players that are trying to reduce that and make more efficient energy efficient buildings. So that should be a net positive. I don't think anyone's going to be against that. Was there anything in mind when you asked that question?
No, I was just wondering. I think of industries that can be slower to adopt new tech, or just punching through a lot of red tape can provide an obstacle. But let me leave you here. If you were listening to this and you were excited by this, what are smart ways to play it? Yeah,
I mean, I think. Like, obviously, you've got companies that are just building things, but right now we're seeing kind of this once in a lifetime, not a once in a lifetime, but like we're seeing a super cycle of AI technology getting embedded in the robotics, and that's at the individual robot level, in the way they interact with each other, and then the system control level. And so we're really bullish on robotics having a play into that. So not just from the design to the operations, but to actually being used more on the job site, more on the ongoing operations, just maintenance, just like making sure things are running and being observed. So you've got like drones, you've got things helping improve the real estate operations themselves. And of course, we have two strategies that I manage. We've got the robo and then think, so robotics and AI. And we think those are two separate but interconnected and increasingly a flywheel of how to play kind of that real. I mean, it's beyond real estate, but increasingly, AI and robotics will be used and thought as part of the design of real estate, not just for human environments, but for manufacturing and logistics and warehouses. But also, data centers. There's been I think $1 trillion in capex announced in the last year for data centers themselves. So there's also environments just for AI and robotics too, and that's going to use a lot of the components and systems. Like companies like Supermicro, they came out with Computex and NVIDIA. They announced their new liquid cooling system, 40% less energy cost, 20% lower capex opex cost. And so when people talk about the fear of energy and AI skyrocketing energy costs, people, I think, are really missing the point that AI is going to solve its own energy cost. And I think that's a hot take, because I think people are more worried about the impact of energy consumption rather than where will AI offset energy consumption, not just from advancements in the data centers, like better AI algorithms, better hardware, better chips, but like what is the impact in the real world? And that's kind of goes back to the real estate conversation.
Yep. Zeno, big topic with a lot of investment implications. Thanks for bringing it to us. Appreciate it.
Yeah.
Well, Tesla shares, they're closing lower today. The company facing new pressures out of China, with Xiaomi saying it will unveil a new EV that could rival Tesla's Model Y. For more, bring in Yahoo Finance senior autos reporter, Praz Sumrian. Praz.
Yeah, so I'm not saying today's move was all because of that car, because it's Xiaomi had announced it, but the YU7, as they're calling it, is a Tesla Model Y competitor. The SU7 sedan in China with the Xiaomi's sedan, it's been selling like hotcakes. They anticipate 300,000 unit sales this year because people love that car. It looks like a Porsche Taycan and a McLaren mixed together, super sporty. It links with the Xiaomi phones like seamlessly, which the Chinese market loves. And that's sort of where Tesla is behind the eight ball, right? They don't have a phone that integrates with the car the minute you walk in, all these different things that Xiaomi can offer. And that's what the Chinese consumers like. And we're seeing even the new refreshed Model Y, the sales are building up, but not as high as maybe they would like at this point. So we'll see if this new YU7 will take it to the new Model Y.
All right, so maybe some EV pressure. What about the robo-taxi rollout? What's the latest there?
This is interesting. So late last week, Morgan Stanley's Adam Jones put out a note talking about how he had a meeting with some
their
clients.
IR, right? Tesla
yes,
IR, yeah.
Tesla IR in Palo Alto with like clients, and the topic of robo-taxis came up, and a few details were emerged, and basically Jonas wrote about how it'll be a small, unsupervised test in Austin. Right? We heard about Austin, the date not set yet. Only 10 to 20 cars will be being
That does
tested
sound small.
at a time,
Yeah.
which seems very small. And then they'll use teleoperation for when a human driver is needed to intervene. So basically, an operator somewhere in Texas or California can remote in and take control of the car if it's, say, stuck behind a stopped car, things like that. So you can help the actual user. Now, this happens as the big bets on Tesla are based on that robotaxi ambition, and you have Waymo with 250,000 rides a week already. So they're sort of behind pretty significantly when it comes to robotaxis. That's unlocking that $1 trillion value of Tesla is because of that.
So on the unsupervised robotaxis in Austin, that starts this summer, correct?
That's what Tesla says. We haven't had any dates yet.
All right.
Yeah, so we'll see.
All right. Praz, thank you, sir. Appreciate it. Netflix stock, meanwhile, closed flat on Monday, climbing back from earlier session losses after JP Morgan analysts downgraded that stock to neutral from overweight. Allie, what can you tell us?
Yeah, so when we think about why this happened, a big reason is because of valuation, right? We've seen this stock hit record after record. Shares are up about 30% since the start of the year. Since October 2022, we've actually seen shares surge nearly 400%, far outpacing the S&P 500 at around 60% over that same time period. And so far this year, Netflix has been viewed as this defensive name within big tech, right? There's been broader concerns about the regulatory environment, about higher prices, the uncertainty with tariffs, and also the potential that the advertising landscape will slow down. So Netflix has been the safe haven throughout that. But recently we've seen more tensions with U.S. and China relations ease significantly. That's lifted the sector overall. So JP Morgan arguing that this could prompt investors to rotate into names that have been more beaten down. So think of Meta, Amazon. Those are some companies that could potentially benefit from this rotation. Also, coming into second quarter, the Q2 time frame, the summer months, usually a softer time period for
Not
Netflix.
as many potential catalysts, maybe.
Exactly.
Yeah, right.
So catalysts are a little bit more quiet right now. So this is really more a near-term call. Over the long term, JP Morgan is very bullish on Netflix. Clearly, this is a company that is an outperformer. We have a lot of strong content coming down the pipeline with Squid Game, with Wednesday, with Stranger Things. Ads continuing to do very well. The ad tier has a lot of momentum. So all of that could prove that this downgrade is a little too cautious. But I think Doug Amick, who is an analyst here, he just wants to err on that side because the risk reward is a bit more balanced here, considering you have share price that is well over $1,000 now. So potentially maybe some bumps in the road in the near term.
What's
but
wrong with Sesame
overall,
Street,
it's
by the
good.
way, before
Yeah,
I let you
Sesame
go?
Street.
Yeah.
We talked about content, right? I mean, Sesame Street, I haven't seen a ton of analyst reaction to Sesame Street in particular. However, in our newsroom, there's been a lot of talk from our producers about how excited they are for this. And this is clearly a push for Netflix to embrace more
How can you not be excited? Look at that. Come on.
content. Yeah, we love this. Cookie Monster, right? That's Cookie. Yes.
I'll tell you though, they got a lot. They got a lot of work in the.
Like Oscar the Grouch. Which one is it? Which one is it? I don't have any.
And I honestly,
Don't come at me.
as the parent here, I should be able to tell you. But I got to tell you, my 6-year-old, Netflix has a lot of work to do. She's all YouTube all the time.
YouTube, and
Yeah.
YouTube is one
Jordan
of the
Matter,
biggest competitors.
huge in my
For
house.
all of these streaming giants, YouTube is a
Yeah.
huge competitor. If you think about kids content in particular, Disney Plus, obviously, probably the winner there, but also Paramount and Nickelodeon. Sesame Street has been on Max, which will soon be rebranded once again to HBO Max since 2016. So losing out some of that core content there, but Max is rebranding more towards adult content, towards more of the family content, not as much kid content. So this is just another opportunity for Netflix to take advantage.
Yeah, I mean,
there.
Sid probably watches it's a little too much YouTube on the iPad.
Yeah, you know what? I
truthfully.
don't think Sid is the only kid out there that's
No,
watching YouTube, though. So
not
that's
at
fine.
all. Not at all. Allie, thank you. Appreciate it. Stick around. Much more As for Trend. That's still to come. Well, Wall Street shakes off a Moody's downgrade. The S&P 500 notching a 6-day win streak here. And here with the trading day takeaways, Yahoo Finance's Jared Blickery. Jared.
What a turnaround, but I have to invoke the spirit of Kenny Loggins once again because we have hit the danger zone. That downgrade sparked an increase, a surge in the 30-year above 5%. This is a year-to-date chart, and I'll put some lines on it in a second, but I want to show you this in candlesticks because the open was about 5.04%. We sunk in the day to 4.94%, and that is 4 basis points higher than the close from the day before. But nevertheless, we are venturing into this territory, and I've been kind of harping on this recently because when the 30-year breaches 5%, that has all kinds of implications for other risk markets. And let me just put those lines on, and I'll show you a 3-year chart. We've been here before, so you can see way back in late 2023, we did breach 5%, and we went a little bit higher than we did today, came back down, so it wasn't a big issue. But why does this matter? It all gets back to the bond market, and this is something that Trump is more focused on than equities this time around. And I showed this Friday. I've been showing this all week long last week, and above 5%, if you get that because of an inflation pop, guess what? Then you tend to get commodities leading, and then stocks just chop around. If it's because real rates are rising, and this is all just some kind of wonky bond market decomposition here, but when that happens, then you get PEs, those multiples compress, and tech lags. What was happening this morning? We saw XLK, that is the tech sector, was the worst performing on the open. So I saw both of these in play. I mean, we're going to take a look at gold in a second here. Gold was up, so maybe commodities are leading. But the bottom line is 5% is clearly a big deal for investors, and we want to see that below. So we ended the day in positive territory for the 5-year or for the 30-year, below that 5% mark. But we're really close, and we could easily breach it again. We have some big auctions on deck next week, and then in a couple weeks.
I feel like you'd have thoughts about the dollar as well.
Oh.
Yeah.
Do I ever? Because the dollar and the yields, their correlation had returned. They were dancing, and now they've stopped dancing once again. So let me show you the price action in the dollar today versus what was happening in yields. So this is still the 30-year. We'll just use this as an example. I'll show the intraday. This starts at 8:20 a.m. That's when the bond market opens. You can see a steady slope down there. Here's the U.S. dollar index, and this starts at an earlier time, but basically from 6 a.m. forward, it was going in the opposite direction, although it did decline later in the day. Why does this matter? These little squiggly lines on this intraday chart, because when all the tariff stuff happened, when we had that tariff tantrum earlier in the year, and all investors were concerned about the magnitude, it was a kind of sell everything in the U.S. moment. And we saw the U.S. dollar decline, and we saw the bid for bonds evaporate, and we saw yields shoot up. So when the dollar goes down, as it did today, and yields up, that's a pretty negative thing, so we do not want to see that continue. I did mention gold before. Just want to show you that gold just had its best day in about 2 weeks or so. That was up 1.5%, kind of supporting the claim that maybe commodities are going to benefit from some of this. And then I also wanted to show you the VIX, because the VIX perked up a little bit today. It started the day just under 20, and you can see it declined below here, but if I show you a year-to-date chart, it's just slowly ratcheting higher. Every time it comes down here, it's at a new higher low. So that's something to monitor as well. It just seems uncertainty is still in the air.
If I was to ask you, what is the biggest bullish signal on your radar right now, you would say what?
It would be a breakout in Bitcoin. However, it was thwarted today. And let me get back to the charts, and I'll show you exactly what I mean. And I'll go to our crypto heat map for this one, and I'll pull up the Bitcoin intraday price action. There it is, up 1.22%. Let's do the year to date, and you can see we came right up to these levels that we were at the all-time highs in January, and we weren't able to breach it here. We kind of came in there, and I'll show you the candlestick here. We hit this 107,000 level, dropped all the way down to 102,000. That's a $5,000 change in Bitcoin to the downside. That's pretty big, and then it jumped right back up to 105,000. So when Bitcoin finally breaks to new highs, that's going to make me a little bit bullish on other risk assets as well.
All right, thank you, buddy.
You
Thank
bet.
you, Jared. Stick around, much more Ask for a Trend still to come. The market's digesting Moody's shot across the bow, downgrading the U.S. credit rating. Yahoo Finance's Julie Hyman joining me now with a closer look in our chart of the day.
Thanks so much, Josh. Well, as we look at today's chart of the day, it effectively measures the debt to GDP ratio, both historically and projected in the future. It comes to us via Deutsche Bank and Jim Reed over there, who sends out a daily chart. This is really what is at issue here, the huge debt load that we have here in the United States and the cost to service that debt. Now, Moody's is forecasting that by 2034, our debt to GDP will be 134%. That's from around 100% right now. The CBO, the Congressional Budget Office, has plotted out to 2055 and put it at 156%. But if we do have the tax cut scenario that looks like is going to go through, it could be as much as 220% going out to that time. So here's what is at issue here. Jim Reed over at Deutsche Bank wrote that this wasn't a surprise, but it's another small crack in the edifice here that really pushes debt and deficits much higher and could be problematic in the future, Josh.
All right, thank you, Julie. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.